overseas. So it's terrific what Darren and the crew's done there in all that time. So no, that was terrific to hear that. But it also neatly segues, because he was talking about retail, into Andre Taye from the NAB. He's Director of Trade and Working Capital SA, and he's going to come and tell us about working capital, and for a lot of small business, it's a very necessary topic. Thank you.
Thank you. I feel a little bit inadequate following Darren at the end of the night. It's going to be a tough ask to remotely resemble anything close. So about a week ago, I was preparing a presentation, this presentation, and I put together some really exciting. I had about 10 slides, and they were full of really exciting information about banking products and all of the fine print that goes with them. I was going to share that all with you today. Then I found out who my company would be tonight, and I'd have to provide an apology to anyone that was looking for an exciting night and to end their night with a long PowerPoint presentation. So I've got 2 slides tonight. I've got 2 slides, 20 minutes, and 3 things really that I was going to touch on. Those 3 things are who we are, what we do, and what we're seeing in the market. Okay, and we'll try and get you on time if I can. So, as also introduced, I'm from the Trade and Working Capital area at NAB. As our name suggests, what we do is the trade side of what we do focuses on imports and exports. So we assist our clients that are either importers or exporters and are dealing in overseas markets. That assistance can be risk mitigation, financing, or simply advice. We see a lot of transactions happening across the state, and we cover all segments of the market. So we cover agricultural, corporate, small to medium enterprise. So we see a lot of transactions for a lot of customers. The working capital side of what we do is obviously for domestic businesses. So we provide a lot of working capital solutions. It is primarily around funding solutions for domestic businesses. They could be trading overseas, trading domestically, whatever it is that they're doing, we look to assist them. I'll talk a little bit more about both of those in the coming slides. So the first of my slides, the writing might be a bit small, so for those of you that can't see it, I will explain what is on there. And it simply goes to what I was talking about earlier. The first 3 boxes are simply around cash flow finance. So, meeting funding gaps, supporting our customers' conversion cycles, simple cash flow finance for businesses in any segment. Fourth box over is managing risk. So risk mitigation is a very large part of what we do. So when we talk about risk mitigation, what we try to mitigate is it's primarily in overseas markets, risks associated with overseas markets. So these could be, from an importer's perspective, ensuring that what they have ordered is what they get. For an exporter's, from an exporter's perspective, it is ensuring that the exporter gets what it is that gets paid for what it is that they've sent overseas. There are also a lot of other risks associated with it: bank risk, country risk, sovereign risk, non-payment risk, a lot of other risks that go with it. Sanctions is a very big part of what we do. So all of these sorts of things we cover and assist our clients with. They could be, in a lot of cases, we have clients that could be first-time importers or exporters. So, you know, the conversations with those sorts of clients are very different from experienced exporters, which we also have a lot of. Providing industry insights. So we have a very large network through the bank in lots of different geographies. We cover a lot of different industries. So, you know, we do have insights that we'd like to share with our clients. Industry insights could also stretch to networking or business matching. And I guess generally talking to our clients about, you know, what is going on, what is best practice in their industry from what we are seeing. NAB trader, second to last box over. How we structure our business in NAB Trade and Working Capital is we are local. We're a local bank, and that's something that we promote quite heavily. We have a team of 7 on the ground. Those seven of us are based in Adelaide. However, we are all mobile. So I myself look after this region. I look after the state, but get down to this region quite frequently. We have local bankers. Trudy, who a lot of you probably in the room will know from spending a couple of days with her. It seems like she knows most of Mount Gambier. We have a dedicated operations team that process all of our transactions in Adelaide. So we are local and we do things here. And lastly, secure online transactions. So in this day and age, what we see is a lot more clients want to do things online. We still do have a layer of support where you can still contact someone and get through to someone local. That person is also in state and usually gets out to see our clients, just like myself. But our online system really is class leading. And for anyone that has or hasn't experienced it, our clients can do all the transactional banking online. Any trade transactions, finance requests, letters of credit, things like that, those can all be processed online. Any foreign exchange, that can be booked, hedging, that sort of thing, that can all be done online now. So it is very much a modular system. So each of our clients have different businesses. They will see different things through our online platform because they may not be doing the same thing. So we attach whatever the business is using to their online access. So this is really the main slide that I'll focus on, and really so I've covered off who we are and roughly what we do. This really is what we're seeing in the marketplace, and I hope that maybe this will give you some insight or maybe help your business with some of the solutions here. So what we're seeing this year, and this is this year, the current year so far, and a bank's year finishes at the end of September. So far, we've seen positive state lending growth. So this is growth of lending facilities for clients taking out additional lending or new clients approaching a bank for lending in the trade and working capital space. So these are all import-export facilities, and they're all working capital facilities. We've seen growth year to date of 35%. So that's across all segments. That's across corporate, it's across agricultural, and it's across SME. Primarily, the largest contributor of that is agricultural. So we've seen a very large take-up in certain style facilities, which we offer to agricultural clients. And we've seen a lot of growth in that market. That growth has actually been over the last 2 years. We saw large growth in agriculture last year as well. But it's a great number. It shows that things are happening. Earlier this week, I was having a look at South Australia as a state's GDP growth, and I saw a number of 2.2, 2.25. Now, obviously, the amount of growth that we are seeing, when you're talking lead indicators versus lag indicators, and lending conversations that we're having really are a bit of a lead indicator because we're extending these facilities now. But it's good to see a positive number for the state. What I would also say about what we're seeing in the state is it's not restricted to any part of the state. So we are seeing across the board growth across the board. So we're seeing it in the southeast, we're seeing it in the north. I was in Port Lincoln last week. We're seeing it in Lincoln, and we're definitely seeing it in Adelaide. So it really is across the state, and it's across a very wide range of industries. What we're seeing is consistent overseas investment. So this has come up earlier tonight. We are definitely seeing consistent overseas investment. We're seeing firms come in from overseas, and they are buying or going into partnership with businesses here. They are buying wholly businesses here. You've seen this in the southeast. You've seen it in the wine industry quite prevalently, but we're seeing it in a lot of other industries. We're seeing it in really all of our segments. We're seeing companies coming in, buying, commercial businesses in Adelaide. We're seeing them buy, it could be grain trading companies. We're seeing them come in and start up cattle export businesses. We're seeing them buy wineries. We're seeing it really across the board, across every sort of segment, sort of level. So it's not really restricted anymore. Prior to, going back about a year or two ago, we used to see that heavily in agri. Now it's across the board. We're seeing it more and more often. And what we're looking at is, these companies are coming in and they're also looking that they're either setting up a local business and then therefore requiring some finance as well. So, there are opportunities there. Australian exports abroad, there's been a massive take-up in overseas companies seeking Australian exports. So, a couple of years ago, we were having a lot of conversations with exporters where, the turnover was down. It was largely because of the dollar. Dollar was quite high, but also which made them obviously uncompetitive. But export contracts were drying up. These days, what we're seeing in a lot of industries is export contracts are coming back. We're having a lot more positive conversations with our clients, and whether it be projects or whether it be export contracts, we're having more conversations with our clients about how they best approach these sorts of scenarios, rather than assisting with cash flow to cater to a longer sort of conversion cycle. We're seeing more CapEx spend. Lots of different industries, capital expenditure is being made. People doing additions to their businesses. Companies that are importing specialist harvesters. Extensions to manufacturing production lines. It really is across the board. We're seeing a lot of capital expenditure happening. When I talk capital expenditure, a lot of this is coming from overseas. That's the part that I see. Primarily machinery coming in from Europe, the US, and Asia. A lot of companies investing where, especially this year as opposed to last year, a lot more money being spent on capex, which is a good positive thing. It supports the fact that we see the growth. We're having more conversations on risk mitigation. Risk mitigation, people trying to obviously cover themselves for the risks that they face in their business, import or export, whichever side that might be. Risk mitigation really is topical. So when we start talking about for any of the exporters out there, we start talking about things like letters of credit, documentary collections. Essentially, for those who haven't heard of those sorts of products before, essentially all it is a bank guarantee. It's a bank guarantee to ensure that an exporter gets paid for what it is that they're sending, and it can take various forms. There's lots of different types of letters of credit, and we assist our clients through that. Going back, pre-GFC sort of years, letters of credit they've been around for a very long time, but they lost a lot of their popularity. A lot of companies weren't using them. They deemed them to be difficult and something that was not necessarily necessary. For companies that have good long-standing relationships with their buyers, why would you put that in place? But as we come into GFC, we started seeing a lot of companies going under. We started seeing banks going under. So those sorts of risks become very more prevalent, and we started seeing some of our clients losing out on getting funds that they were expecting. So post GFC and rewinding to now, contracts are coming back. People have learnt lessons. People have talked to each other and learnt lessons, and that really is starting to come back. People are really watching out. When we have capex, it's not just the bank that is very conscious about making sure that these goods arrive. It's also our clients making sure and understanding why the bank has certain requirements on the way that we request things be imported, those that are funded. We're having a lot more of those sorts of conversations. We're also having a lot more conversations on working through new contracts. So that really differs from 1 or 2 years ago, when we're having a lot of conversations with businesses who were approaching the bank saying, we need extended sort of terms from the bank, we need a bit of leniency, how better can you help our business, how can we reduce costs? Less of those conversations and more of, we've got this new contract or this new project that's about to happen, how can the bank support us? We're having a lot more of those sorts of conversations. We're having a lot more conversations around, this could be upcoming, what will you do to ensure that the bank is best placed to assist our business? So that's the kind of thing that we're seeing. Growth sort of conversations, positive conversations, and really it's across the board. Trudy's had me here for the last 2 days, and in the last 2 days we've seen 7 clients, and those 7 clients have all had the same sort of conversation. It's all been positive. So it's a great story, and it's a great story down in the southeast. So what are the sort of things that we're responding to these clients with? What are these clients using? What are they doing? And what do we see as best practice and most flexible and cheapest? And what sort of facilities should perhaps you be talking to a NAB about or your own banker about? These 5 red squares really are what we're seeing the most of. So the first one is trade finance. Trade finance is a simple cash flow solution. It covers the whole conversion cycle, a business's conversion cycle. So when I talk conversion cycle, what I mean is if a business has its suppliers that it needs to pay, it may hold stock, and then it's got its buyers that it receives payments from. That's a conversion cycle from the time that it pays out money to the time that it receives money back. Whatever a business's conversion cycle is, a trade finance covers the whole cycle. So, a business will be out of pocket until they receive money back. We can fund that gap. What I've done, rather than giving you all of the ins and outs of all the products, as I mentioned, is I've just put a couple of bullet points, 3 bullet points for each one, just so that it resonates and really to give you the summary. So with trade finance, it's short-term working capital covering the whole conversion cycle. It's very attractively priced. So when I say attractively priced, what I mean is cheaper than conventional methods of finance, such as overdrafts, things like that. It's stock related. And collateral security is usually strength of balance sheet and bricks and mortar security. Okay, so in terms of a secured product, yes, that's a secured product when the bank requires security. Invoice finance, really this is debtor finance. So you would have all come across, I dare say most of you have come across this sort of a product before. Essentially, a company has a debtor book. They've got money that they're expecting to receive in. We're accelerating that debtor book for them. We're extending 80% of that value, and the debtor book is the security. That's really what it is. I have to stress it's not factoring. So, factoring is a bad word. We tend to hear, lending of last resort when we're talking about that sort of thing. People still have that sort of mindset when it comes to debtor finance. This is a type of facility that a lot of our corporate clients use as a daily facility. It's a facility for growth. It's a facility for startup businesses. It's a facility for, it's a facility where it fits a need, where there is a debtor book that is, sufficient to cover. Borrowing base, this is probably one of the largest areas of growth for us, and it is highly prevalent in the agri space, but that's not to say that it's limited to that space, because we do have other clients in the SME space that are dealing in a commodity that we can extend value on. So when we talk about unsecured facilities, we have a spectrum. You've got fully secured facilities with bricks and mortar sort of thing, which traditional banks love that sort of stuff. But then you've also got the bespoke sort of tailored products. Borrowing base is a tailored product, and I'll talk through that. But in terms of a security requirement, stock and debtors is what I'm talking about as security. So, we consider these as relatively unsecured sort of products, secured by the product itself, not secured by anything collateral. So with borrowing base, what we're doing is essentially we're funding the company's stock position and the debtor position. Okay, so a company would hold a certain amount of stock, we can fund a percentage of that. Debtor position as well, we can fund a percentage of that. So as an example, the stock position might be, we might be funding 60% of their stock value and 80% of the debtors, as an example. What that depends on is, it depends on the type of commodity. It's commodity specific. So where you have, the commodity needs to have a liquid market, where you can quickly liquidate stock. And when I talk about this, what I mean is stock like grain, stock like cattle, stock like wool, stock like, what else do we have? Commodities with liquid markets. In the SME segment, we have metal. So, we can liquidate metal quite quickly. There are liquid markets, auction houses, whatever it is to liquidate these sorts of products. So in that sort of case, we can identify that there is a market value for it. So therefore, we can attribute a value to it. So essentially, that's borrowing base, and we've picked up, companies have picked up a lot of those sorts of facilities because it fulfills the need for them. Letters of credit, we talked about that. Essentially, it's a bank guarantee, providing security to suppliers and buyers. It is a fully secured facility because it is a bank guarantee. There are lots of different types of LCs. What I would probably say with letters of credit is, if you've come across them in the past and they've been difficult, you probably need to talk through that. There's a couple of aspects to that. So a letter of credit can be as easy or as difficult as it's made to be. If we're talking documentary credits where they're triggered by shipping documents, we've seen letters of credit as easy as the provision of an invoice and a bill of lading. And there was no requirement as to what they say. So that fulfills a trade. Whereas you could have other letters of credit which call for 20 sets of documents under it, and you've got a lot of conditions on those documents as to what they need to say. The more conditions you have, the harder it is to comply with it. So, if there's been a bad experience in the past, perhaps speak to your bank about that to fine-tune it. You also need to bear in mind that that it takes two to tango. So, the letter of credit requirements also come from the buyer or the supplier agreeing to those conditions. But at least, you can have a conversation to understand where it all stands rather than just accepting what you get. And the last one is import lease. So this is where it relates to capital expenditure. So what we find is with a lot of the machinery or capex that's coming in from overseas, traditionally a bank can't actually finance that until it's in Australia, either commissioned or a PPSR can be registered. But how does it get here? So what we do is our client has a supplier overseas. We'll incorporate either a letter of credit, or if there's no letter of credit required, we can waive that requirement. Perhaps an inspection needs to be done to ensure that the goods that are ordered are what arrives. So we can assist our clients through that. Insurance is covered off, freight forwarding is covered off. Goods are ordered, we provide bridging finance whilst the goods are on the water in transit until they get to Australia. Any foreign exchange liability or exposure is locked in, so we do the hedge as well. So really everything is covered until it gets to Australia. We know what the Australian dollar liability is going to be, and essentially as soon as it can be taken over on a long-term asset finance arrangement, chattel mortgage, whatever it is, asset finance simply pay us out internally. So it's a one-stop shop to enable machinery to come in from overseas. So really, that was what I was going to talk about today. I hope I've propped some interest. Hope I've also saved you some time. But if there's any questions, I'm happy to take them. And if anyone has any interest in any of these products, I've got the whole. I did actually make the whole presentation. So there is all the fine print there if anyone's interested in any of these products. Thank you.